Welcome back to Strategic Signal. In today's video, we're diving into Chapter 3 of our course, Understanding Public Companies. We'll break down what it means for a company to go public, starting with the initial public offering, IPO, process. You'll learn how companies prepare for an IPO, the role of underwriters, and why transparency, regulatory compliance, and corporate governance are essential for public companies. We'll also explore real-world examples like Rivian and Airbnb to understand the challenges and opportunities that come with being publicly traded. By the end of this video, you'll have a clear understanding of how public companies operate in the stock market and what investors should look out for. Whether you're an investor or just curious about the stock market, this chapter will give you valuable insights into the world of public companies. Don't forget to subscribe and hit the notification bell so you don't miss any future videos. Let's get started. Chapter 3, Understanding Public Companies. This chapter explores the world of public companies, from their initial public offering, IPO, to secondary offerings, while emphasizing the importance of transparency, regulatory compliance, and robust corporate governance. What are public companies? A public company, also known as a publicly traded company, offers its shares for sale on a stock exchange, making it possible for anyone to buy and sell them. Ownership is distributed among numerous shareholders, which is different from private companies, where ownership is typically limited to a smaller group. The IPO process, going public. An initial public offering, IPO, signifies a private company's transition to becoming a public entity. This intricate process involves several crucial steps. Preparation. The company prepares its financial records, establishes a strong board of directors, and ensures compliance with regulatory requirements. This preparation is aimed at meeting the strict standards of public markets and attracting investors. Choosing underwriters. Investment banks, known as underwriters, are chosen to manage the IPO. They assist in determining the initial share price based on market conditions, investor demand, company valuation, using methods like discounted cash flow, DCF, analysis, and price to earnings, PE, ratios, and valuations of comparable companies. Discounted cash flow, DCF, analysis. DCF projects a company's future cash flows and discounts them back to their present value, which allows investors to estimate the intrinsic value of the company. It's particularly useful for companies with predictable cash flows, as it measures their intrinsic worth by estimating how much cash they will generate in the future. Price to earnings, PE, ratio. The PE ratio compares a company's share price to its earnings per share, EPS. It helps investors determine how much they are paying for each dollar of earnings. A higher PE ratio could suggest that the market anticipates significant future growth, whereas a lower PE ratio might indicate undervaluation or slower growth prospects. Regulatory filing. A registration statement, including a prospectus detailing the company's business, financials, and potential risks, is filed with the Securities and Exchange Commission, SEC. This ensures transparency and provides potential investors with essential information. Marketing, roadshow. The company and underwriters present the IPO to potential investors, generating interest and assessing demand. This process helps in setting the final offering price. Pricing and launch. The final offering price is determined, and the shares are listed on a stock exchange, allowing public trading to commence. The importance of transparency, regulatory compliance, and corporate governance. Transparency. Public companies are obligated to disclose vital information, including quarterly and annual reports, 10K filings, as well as any significant changes impacting their business. Transparency cultivates trust with investors and facilitates well-informed decision-making. Regulatory compliance. Adhering to SEC regulations and those of other regulatory bodies is paramount. This involves regular financial reporting, audits, and compliance with accounting standards, GAAP. Compliance safeguards investors and ensures fair market practices. Corporate governance. Strong corporate governance entails establishing well-defined roles for the board of directors, management, and shareholders. Effective governance prevents fraud, mismanagement, and conflicts of interest, protecting shareholder value and attracting investment. Maintaining sound investor relations by keeping shareholders informed about the company's performance, growth strategies, and any major corporate decisions is also crucial. Challenges faced by post-IPO companies. Market volatility. Newly public companies can encounter substantial stock price swings due to market speculation and fluctuating investor sentiment. Macroeconomic factors, like inflation, interest rates, and industry competition, also contribute to volatility. For example, rising interest rates can increase borrowing costs, potentially impacting a company's growth and profitability. Increased scrutiny. Public companies face intense examination from analysts, investors, and the media, demanding higher levels of accountability and transparency. Operational adjustments. Adjusting to the requirements of being a public entity necessitates operational changes, including enhanced reporting requirements and more complex governance structures. Pressure for short-term performance. Public companies often experience pressure to deliver short-term results, which can sometimes clash with long-term strategic objectives. Moreover, environmental, social, and governance (ESG) performance is gaining significance. Many institutional investors now factor in a company's sustainability practices and governance structure when making investment decisions. Companies must strike a balance between financial performance and responsible corporate behavior. Risk factors in IPOs and public companies. Investors should carefully assess various risk factors before participating in an IPO. Market volatility. Stock prices can be highly susceptible to economic events, changes in consumer demand, and geopolitical developments. Newly public companies can be particularly vulnerable to such fluctuations. Regulatory changes. Modifications in laws or regulations, especially in heavily regulated industries such as healthcare or finance, can significantly impact a company's business model and profitability. Industry-specific risks. Each industry encounters its unique set of risks. For instance, technology companies may grapple with rapid innovation cycles and data security concerns, while retail companies might be vulnerable to shifts in consumer preferences. Company-specific risks. Factors like dependence on key executives, unproven business models, or high debt levels can amplify risks for investors. Evaluating the company's management, business model, and financial health is crucial to understanding potential pitfalls. Case study: Rivian Automotive, RIVN. Rivian's IPO, which raised approximately $12 billion, exemplifies the intricacies of going public. The initial share price of $78 surged to over $100 on the first trading day, fueled by investor enthusiasm for electric vehicles. However, subsequent production delays and supply chain problems negatively affected the stock price, highlighting the challenges and volatility encountered by newly public companies. Additional case studies. Airbnb, ABNB. Airbnb's IPO in December 2020 was successful due to robust investor demand, and the company's demonstrated resilience during the COVID-19 pandemic. The company adapted by shifting its focus towards local stays and long-term rentals, attracting investors who valued its strong brand and innovation. DoorDash, DASH. DoorDash capitalized on the surge in demand for food delivery during the pandemic. Its 2020 IPO was successful, but concerns about competition and the sustainability of growth have since impacted its stock price. WeWork's unsuccessful IPO attempt in 2019 serves as a cautionary tale. The company faced intense scrutiny regarding its unproven business model, inflated valuation, and governance issues. Ultimately, the IPO was withdrawn, highlighting the risks of overvaluation and mismanagement. Facebook, Meta Platforms. Facebook's 2012 IPO encountered technical difficulties and skepticism about its valuation. However, over time, the company leveraged its massive user base to become a dominant force in digital advertising, demonstrating how strategic execution can lead to long-term success. Market dynamics. Macroeconomic factors. Macroeconomic trends, such as inflation and rising interest rates, can significantly impact public companies. Higher interest rates make borrowing more expensive, potentially hindering a company's ability to invest in growth initiatives. Inflation, on the other hand, increases the cost of goods and services, squeezing profit margins if companies are unable to pass on these costs to consumers. Industry trends. Public companies must also navigate industry-specific dynamics. For example, technology companies need to stay ahead of rapid innovation cycles and changing consumer preferences, while companies in the energy sector may face fluctuating commodity prices and regulatory changes related to environmental policy. Investor relations and its importance. Investor relations, IR, are crucial for public companies to maintain trust and communication with their shareholders. Key elements of investor relations include communication strategies. Public companies regularly update shareholders on their financial performance and strategic outlook through quarterly earnings calls, annual reports, and investor presentations. These communications help maintain transparency and align investor expectations. Shareholder engagement. Engaging with shareholders, particularly institutional investors, ensures strong relationships and the alignment of long-term goals. Companies often hold regular meetings, issue statements, and provide accessible information to build investor confidence. Transparency. Providing clear, honest, and timely disclosures about company performance, potential risks, and strategic initiatives is vital to maintaining investor confidence. Transparency helps prevent misinformation and market speculation, leading to more stable stock performance. Corporate social responsibility and ESG. Environmental, social, and governance, ESG, criteria have become increasingly important for investors in evaluating a company's long-term sustainability and ethical practices. Companies with strong ESG policies often enjoy greater trust from the public and institutional investors, which can contribute to a more favorable stock price. ESG considerations. Investors are focusing on how companies manage their environmental impact, ensure diversity and inclusion, and maintain strong governance structures. Many institutional investors now expect companies to incorporate ESG principles into their operations, as these factors can directly impact long-term financial performance. Comprehensive Guide to Secondary Public Offerings, SPOs. A secondary public offering, SPO is a financial event in which a public company issues additional shares after its initial public offering, IPO. This process allows the company or existing shareholders to raise capital by selling shares to the public. SPOs can be either dilutive or non-dilutive, depending on whether new shares are created or existing shares are sold. Types of secondary offerings. 1. Dilutive secondary offering. A. In a dilutive SPO, the company issues new shares to raise additional capital. B. This increases the total number of shares outstanding, which can dilute the ownership percentage of existing shareholders. C. However, this offering provides the company with funds for expansion, debt repayment, or other strategic initiatives. 2. Non-dilutive secondary offering. In a non-dilutive SPO, no new shares are created. Instead, existing shareholders, such as early investors or insiders, sell their shares to the public. The company does not receive any proceeds from this type of offering, and there is no dilution of existing shareholders' ownership. Why do companies conduct secondary offerings? Companies may choose to conduct a secondary offering for several reasons. 1. Raising capital. 1. Companies often use dilutive secondary offerings to raise capital for growth initiatives like acquisitions, research and development, R&D, or expansion into new markets. For example, Tesla raised $2 billion through a secondary offering in 2020 to fund its ambitious growth plans. 2. Providing liquidity. Non-dilutive secondary offerings allow early investors or insiders to cash out some of their holdings without affecting the company's operations. This is common when venture capitalists or founders want to realize gains from their investment. 3. Reducing debt. A company may use the proceeds from a dilutive SPO to pay down debt and strengthen its balance sheet. This can improve financial stability and free up resources for future growth. 4. Expanding the investor base. By issuing more shares, companies can attract new investors and increase liquidity in the market, making it easier for investors to buy and sell shares without significantly affecting the price. Impact on stock price. The announcement and execution of a secondary offering can have varying effects on a company's stock price, depending on several factors. Stock prices may decline upon announcement. 1. Dilution concerns. In dilutive offerings, issuing new shares increases the total number of shares outstanding. This dilutes existing shareholders' ownership percentages and spreads earnings across more shares, potentially lowering earnings per share, EPS. Investors may respond negatively to this dilution by selling off stock, leading to a decline in share price. Negative market perception. Investors might interpret the need for additional capital as a sign that the company is struggling financially or lacks sufficient cash flow. This perception can lead to a drop in stock prices as confidence wanes. Discounted pricing. SPOs are often priced below the current market value to attract investors. If the offering price is significantly lower than expected, it might signal that the company's stock is overvalued, prompting a sell-off. Stock prices may increase upon announcement. Strategic growth initiatives. If investors believe that the funds raised will be used for promising growth initiatives, such as acquisitions or expanding into new markets, they may view the offering positively. For instance, CRISPR Therapeutics saw its stock price rise after announcing an SPO, due to investor confidence in its future growth potential. Strengthening financial position. Companies that use SPOs to reduce debt or strengthen their balance sheets may boost investor confidence in their long-term financial stability, leading to an increase in stock price. Increased liquidity. By increasing the number of shares available for trading, secondary offerings can improve liquidity in the market, making it easier for investors to buy and sell shares without significantly affecting price levels. Post-offering price movements. After a secondary offering is completed, stock prices can continue to fluctuate based on market reaction. If demand for the offering is strong and oversubscribed, more buyers than available shares, this could indicate strong investor interest and lead to an increase in stock price post-offering. Use of proceeds. How effectively a company uses the funds raised through an SPO plays a critical role in determining long-term stock performance. If the capital is used wisely, such as for strategic acquisitions or reducing debt, it could enhance shareholder value over time. Market conditions. Broader economic conditions and industry trends can also impact post-offering performance. For example, if an industry faces regulatory changes or economic headwinds after an SPO, it could affect stock prices regardless of how well executed the offering was. Pros and cons of secondary offerings. Pros. Access to capital without debt. Dilutive secondary offerings provide companies with access to additional funds without increasing debt levels. Improved liquidity. Increasing the number of publicly traded shares can enhance liquidity, making it easier for investors to buy and sell stock. No dilution in non-dilutive offerings. In non-dilutive offerings, existing shareholders do not lose ownership percentage since no new shares are issued. Cons. Dilution of share value. In dilutive offerings, issuing new shares spreads earnings across more shares, potentially reducing EPS and shareholder value. Negative market perception. Investors may view an SPO as a sign that management lacks confidence in future cash flows or profitability. Short-term volatility. The influx of new shares can cause short-term volatility as markets adjust to increased supply. Real-world example. Tesla's 2020 secondary offering. Tesla conducted several successful secondary offerings over recent years. In February 2020, Tesla raised $2 billion by selling 2.65 million new shares at $767 each, about 4.6% below its previous closing price, allowing it to bolster its finances and fund growth initiatives, like expanding production capacity and developing new products, such as battery technology. While there was short-term volatility due to dilution concerns, Tesla's stock continued its upward trajectory as investors believed that these funds would support long-term growth strategies, like scaling electric vehicle production globally. Additional considerations. Timing matters. The timing of an SPO can significantly influence its success or failure. During bullish markets with high investor confidence, companies are more likely to see positive reactions from secondary offerings because investors are more willing to invest in growth stories. Pricing strategy is key. The pricing strategy for an SPO is crucial. Offering too large a discount could signal weakness, but pricing too high could lead to undersubscription, lack of demand. Successful pricing balances attract new investors while maintaining shareholder value. Long-term versus short-term impact. While short-term volatility is common after an SPO announcement due to dilution concerns or market speculation, long-term performance depends on how effectively companies use the raised capital. Conclusion. Secondary public offerings are essential tools for companies looking to raise capital without taking on debt or providing liquidity for early investors. However, they come with trade-offs, such as potential dilution of shareholder value and short-term volatility in stock prices. Investors should carefully evaluate several factors. including market perception, use of proceeds, timing of the offering, and broader economic conditions, before reacting to an SPO announcement. Understanding these dynamics helps investors make informed decisions about whether participating in or holding through a secondary public offering aligns with their financial goals. Thanks for watching Strategic Signal. I hope you found this video insightful and helpful as you continue your journey in mastering the stock market. Before you go, don't forget to hit that subscribe button and tap the notification bell so you don't miss any of our upcoming videos. Trust me, you won't want to miss what's coming next as we dive deeper into the world of investing and unlock even more strategies to help you succeed in the markets. Also, we've packed the video description with questions and answers that might help clarify some of the concepts we discussed today. So, be sure to check that out. And now, I'd love to hear from you. What did you think about this chapter? If you have any questions or thoughts, feel free to drop them in the comments section below. I'll be checking and responding to as many as I can. Thanks again for tuning in, and I'll see you in the next chapter.